So we're a little bit behind. I'm going to try to catch up a little bit. 2023 in review. Last year I reported that, well, we have a conflict in Ukraine. So I think each year, hopefully I don't have to report on a new war or a new conflict. Some trade disruption, possibly. We haven't seen it yet. But the buzzword last year was artificial intelligence. In fact, our industry used it. So when you hear the distant smell of s'mores cooking on the campfire really means 2 burned out units in an apartment building. So, but it hasn't replaced me yet. Our economy has been resilient. It's kind of like we don't pay attention to the rest of the nation. We keep trucking forward from housing deliveries to retail to even the office sector performing well in this area. Inflation did slow. Interest rates stabilized. Probably not at a level that you would like, but they stabilized. Cap rates did move up a little bit, and the commercial market did slow a little bit, which I'll get into in a minute. And the housing market does remain very tight, which Chris Lammer will get into in a few minutes. So, nothing new. Same. I should have just said ditto on this slide. Low unemployment. We have a stable economy. Housing shortage. Some upticks to be concerned about nationally is an increase in personal debt and a lower savings rate among Americans. Bottom line is the money from 2021, COVID ran out, and we're still spending like we had money from 2021. So I think that's an adjustment cycle. And commercial real estate. This is a 22-year look back. We track it both from land, commercial, and multifamily. The bars to the right, you can see 21 was awesome, 22 not. A little decline, and we declined again in 23. And we'll break down those numbers here in the next few minutes. Commercial, which includes retail, industrial, multifamily, and office, had total sales of $416 million last year, representing 154 transactions. As you can see, we're down 13% and 17% respectively. Land did decline 42%. That's $305 million in total sales last year. But in 2022, we had one single sale in Hesperia for $87 million. So that impacts moving forward when you have such a high number. So the transaction count, 2022, we did 1,919 transactions, fell to 1,429 transactions, 25% decrease. The sales decreased 42%. Again, that's in relation to that $87 million sale. Last year, land, commercial, total transactions, a little over $773 million, down 27% for the year, and a total of 2,145 transactions, a 25% decline in commercial activity. Interestingly, what's our sweet spot for sales price in the high desert? Very little over $10 million, very little under $250,000. Our sweet spot up here is $250,000 to $2.5 million in the commercial market. So with that, let's dive a little bit deeper into each sector, and I'd like to invite Bob Basin, Executive Vice President of Coldwell Banker Commercial, to dive into the industrial market. He gets the pleasure of talking about the exciting news, and then I'll bore you with like capital markets and interest rates in a few minutes. Bob.
Thanks, Jason. Okay, I get to talk about the exciting stuff that it's kind of been gone through the whole program today is the industrial market. I'm going to take a look at the kind of the 30,000-foot view. The mayor's panel kind of went over the individual projects that have went on in 2023 and what they're expecting in 2024. So today, I'm going to talk to you about vacancy rates, lease rates, new deliveries in 2023, construction in 2023, absorption rates, cannabis inventory repositioning. No, we're not going to talk about moving marijuana from one place to another. We're going to talk about the buildings. We're going to talk about the entitlement process, what went on in 2023, and we'll get a little bit into sales volume. Okay, kind of a snapshot of our market. You can see vacancy rates increased to 6.3% in 2022. They were 2.2%. You might think that's kind of alarming, but the reality is 6.3% is a very low vacancy rate anyway, and there's an explanation for that we'll go into in the next slide. Lease rates, even though vacancy rates went up, lease rates went up about 10% from $1.01 to $1.11 in 2023. Absorption rate did decrease from the previous year from 2.5 to 1.3, but that's still 1.3 million square feet of positive absorption. That is those are fantastic numbers. So real quick, I'll go over real quick where the inventory is kind of dispersed over the high desert. Adelanto, 5,300. Apple Valley, just over 4 million. Barstow, 1.4 million. Hesperia, 7.5 million. Victorville, almost 11 million. And the rural, unincorporated areas, you're just over 136,000 square feet. So we will get into our graphs now. I love graphs because as I work in the market day to day, I see a day-to-day thing going on. At the end of the year, when you start studying this and you start graphing it, you look at it and go, wow, I didn't realize that happened. And here's an interesting one. I'm not sure if you can see this pointer, but you can see where our rents went up to $1.11, and at the same time, vacancies went up, which is, you would think would be the opposite, that vacancies would be low. But the reality is that 6.3% was mainly because of those two 1 million plus square foot buildings that came online in Hesperia in 2023. You have 2 million square feet come online without a tenant yet. In this market, it's going to affect the vacancy rate. Again, we talked about net absorption was down, but still is in the positive. And here we get into net deliveries and vacancies. Net deliveries, which is your blue bar, you can see that was way up. There's your 2 million square feet that was added to the inventory. And then, of course, it didn't have a tenant yet. That has been resolved with one of those buildings, and so you won't see that in next year's report. But the vacancies were up as well because of that. Sales volume. Sales volume versus 2022, you can see went way up. There's not a lot of inventory that sells in the high desert, so it just takes a few deals that can really skew the graphs. But you can see that we were up over 350 million in 2023 versus just under 150 million. But what was interesting about this graph is that at the same time that the sales volume went up, the sales price per square foot was trending down, which I thought was kind of odd. Normally when you have that kind of pressure, the prices are going to be going up. But again, in researching that, it was pretty easy to figure out what was going on when you looked into the major transactions that happened in our desert in 2023. We'll take this first one in Adelanto, 5.5 million square feet in the cannabis-zoned area, and keep track of that. You have $184 per square foot sale price. Caliente in Hesperia, this was a big one at almost 24,000 square feet, $6 million. And if you look at that sale price, $254 per square foot. But our other significant transaction was 12 million. I mean, that's a big sale in the high desert. But when you look at it, it's all the way down to $80 per square foot. And I think that's probably what trended that line down as far as sales price per square foot. So, like we said, vacancy rates increased to 6.3 from 2.2. The overall lease ask rates ended at $1.11 per square foot, which is about a 10% increase year over year. New deliveries were up 14% with 2.5 million plus. Under construction in 2023, over 600,000 square feet. Your net absorption was down 47.5% year over year, but still we had 1.3 million in positive absorption. Now, when we get into that vacancy rate, the 2.2 from the previous year versus 6.3, in our market, when we look at the 50,000 square foot and under, that vacancy rate remains at 2.2%. The spaces in there are still desired. There's a lot of businesses that are moving up here from down the hill. So the rents, the vacancies have stayed low, but the rents have stabilized. I mean, it seemed there for a couple years ago that the rents were going up almost monthly, but we're pretty much stabilized now with the rents in that space. cannabis inventory repositioning. Okay, so what we're talking about there is the cannabis industry is contracting, bottom line. And so you see ownership of buildings that were set aside or were being used for cannabis no longer have those tenants, so they're starting to reposition those for non-cannabis tenants, and the prices reflect because the lease rate for what we'll call traditional or non-cannabis versus cannabis is about 50%. 2023, we had 33 million square feet going through entitlement process or the development. We just heard Apple Valley say they have 20 million themselves that are in the entitlement process right now. So the whole industrial market is, it's a great foundation, I think, great concrete foundation. I see continued growth in the high desert that can be sustained. Again, this was the big view looking down. If you're a numbers person, everybody should have one of these. There's an article in there in the industrial section that Dr. Ron Barberi and Stephen Thompson wrote that has all the numbers and numbers and numbers. So anyway, that's it. I'm excited about it. I think this industrial surge is going to change the face of our high desert.
Bob. Well, thank you very much. Up next is Jerrad Schindel, Vice President, Coldwell Banker Commercial, to dive into the apartment multifamily market. Give a big warm welcome to Jerrad.
So I'm going to rush through this. We're a little bit behind. Chris, Jason, and I are going to kind of keep up. So we're talking multifamily today. So if you have a question for me, I'll be in the back afterwards. But like I said, thanks for sitting right in the front, Mike. Appreciate it. You told me you were going to heckle me. I didn't believe you. So quick recap of what happened last year. We had some cap rate compression. We're about 6%. I think there's a laser on this thing. So we're about 6% now. Price per unit was down to $115 a door. Volume was down. But the main thing that I want to point to is the months per sale. So you can see that it's almost at 7. It was almost at 7 last year. It's sitting. It's taken longer to sell these properties. These properties are on the market longer. There's more headaches. Lenders aren't our friends right now. They don't want to lend to us. That's kind of where we're at. Price distribution, very similar to land. We're right in the middle, $1 million to $2 million. That's our sweet spot. We'll have a little bit over 5, but $1 to $2 million. So we're a really affordable investment option for mom and pop type of investors. So what happened with multifamily? You saw the sales volume was down. You saw the cap rate compression. You've heard all the news. There's some regulation that we're not going to get into because didn't know how many politicians would be here. But the main thing was insurance. So if anybody's had any property that they've purchased or tried to get, if you're a property owner, you definitely have got either a notice of cancellation sometime or your premium definitely went up. So we call this a nightmare. Anytime anybody has to get insurance now, it's a nightmare. I feel bad for our insurance agents. I don't know where they're at. But we feel bad for them. Buy them a beer. So the other is cost of capital. Everybody knows interest rates went up. We don't need to spend a whole lot of time on that. We can kind of skip through it. But the one that I am going to spend some time on is maintenance cost. This is something I don't hear a whole lot of people talking about. Building costs are out of control. The cost to rehab a unit is out of control. Simple 2-bedroom unit in 2020, we could turn for $3,000 to $5,000. $5,000 was a full turn, cabinets, countertops, everything. We're $10,000 to $15,000 on an average turn now. So more than doubled. This is a graph that Ryan McCachran shared with me. Thank you, Ryan, wherever you're at. This is a textbook definition of everything that's going on. We already know about inflation, premium rates, but look at the replacement costs that started in 2021. Absolutely shot through the roof. So this is not an extensive list. This is just a list that I could find, and Ryan shared with me, is these are people that aren't writing policies anymore in California. So I had to ask Ryan, I'll get out of the way, but I had to ask Ryan to help me out, what the heck is going on? Why can't we get insurance? And so basically, replacement costs are too high. For every dollar that goes into a premium, $1.30 is going out. So obviously, there's going to be some losses. We're, according to Ryan, expectations, 25, 26, that'll get stabilized. So the multifamily market, we're going to have to live with this for a while. We're going to have to keep this in top of our mind when we're looking for insurance policies and when we're buying properties. This is going to be a problem that we're going to have ongoing moving forward. Residential, commercial rates, we all know, people are going to talk about that more in detail. No problem. This I want to spend time on. So overall construction cost. We have some builders in the room. We have some apartment owners. Construction costs have gone through the roof, and they haven't really leveled off. Right? They continue to keep on going. Labor is tight. Everything's a struggle. This is regional, so this isn't even our local area. But as you can see, locally, we're not the only ones. We're following the trend lines all the way through. And this, I just love this graph. I'm just going to let you guys stare at it for a minute, if you can see it. All right? So everything has gone up. You can see 21, 22, 23, it kind of stabilized a little bit. I'll let you guys take pictures. All right. So you can see that everything has gone up. Everything finally started to stabilize this year. But look at the jump from where we were at pre-COVID to now. We're up over 100%. What happened there? All right. So the overall market, what are we looking at? And we have some hurdles. Insurance is a hurdle, but that'll work itself out. We know that construction costs, and we know that rates are. We know that all of that is going to work itself out over time. We're slow and steady growth. You heard Lena talk about big. You heard all of the economic activity that's happened. We had a great panel, told us everything that was going on. That is going to create demand. We need it. We don't have enough new units. Everything will be good moving forward. Demand's outpacing supply. Very similar. So, do we keep investing? Yes. Is the market still good to invest in? Yes. But we underwrite more aggressively. So 21, money was flying everywhere. 3% interest rates, let's buy whatever we can, let's move forward, let's keep it going. Rates are going up, they're jacking up through the roof. Some owners were renting, things 30% above if they got a vacancy. That is not happening. We're having slow and steady rates. Your rents are going to go up slow and steady. You just got to be more aggressive with underwriting. Our average building, 1980s, right? Think about all the roofs that need to be replaced, HVAC units, all of that's coming up right as replacement cost is there. So you have to be very careful, look under the hood, and start keeping reserves. So this is a graph that I used last year. Wanted to show it again. We stole it, I think, from Carr. I think it came from Carr, right, Chris? Yeah. So it came from Carr. And what I love about it is that 26 is now the time that your kids will move out of your house. So if you got young kids, sorry, they're going to be there a little bit longer. So that is the average median. It's a median for when people are moving out. But they're not buying a house till they're 34. So who's good at math? 8 years of solid renter right there, new household formation that's coming on top of all the jobs that are coming, on top of all the development. What's going to happen to demand? So this is a quick breakdown of the area. I didn't put this in last year, and somebody yelled at me, so I'm sorry. I put it in this year. You can see Apple Valley, Hesperia leading the way like always. They're the high demand markets. Barstow, so funny story about Barstow real quick. So Barstow actually had a banner year. You could argue a big year if you're going to go that way. The reason that the sales price per unit went down is there was 2 buildings that sold. One was in a foreclosure, and the other one had unruly tenants, we'll say it like that. Sold quick, sold below market, but it'll be coming back on the market probably in the next couple of years. So when I do this presentation next year, you're going to see that number a lot higher. But they actually had more sales volume in Barstow than any other market, relative to where they were at last year. So notable transactions. I'm gonna paint a picture here. Yeah, all right. So I'm gonna pay attention to that right there. So you can see pre-COVID numbers. 2018, these guys bought this building for $3.5 million. They turned around and sold it in 2023 for 5.6. Not a bad return, right? But it took them 2 years of being on the market. So they were there for 2 years, on and off, went all the way through it. Same thing, right? 2022, just under 1.4. 2023, you can see the number. So this was a 2-bedroom, 1.5 bath. This guy just barely got out of it through the skin of his teeth. Something going on there, right? Bad buy, didn't realize the roof, HVAC, something, but got out of it. Barstow. So this is the gem. So 16 units were fire damaged. That didn't stop people from living there, though. There were people squatting. We had to get rid of them. It was in foreclosure, red tagged. The city of Barstow, I think, was ready to bulldoze it, if you know. But they got it. We got it sold, ready to go, and we are now in plan check for putting those units back online. They did their structural, they did everything else. Hesperia, this guy just hit the lotto. So 2019, right under, just right above $1 million. Turned around, sold it for 1.8. He didn't do too much to it. I mean, kept it clean, but he was right there. So pre-COVID, post-COVID, right? That's what all of those had in common. Well, pre-COVID units now were above. A lot of that was bought with cheap money. This one was actually a 1031 buy, so that's a little skewed, a little bit higher. And then Victorville, which is my all-time favorite. So 2019, 6.1 million for 60 units, not bad. Sold for 8.5 this year, or last year, 2023, but under 4%. So that's why they got that price. They had fixed, locked-in financial kind of transparency there. So I think I'm done. Yeah, I'm done. All right, he's waving me off. So I'm going to hand this back to Jason, and thank you.
I didn't have a hook, Jerrad, swear. So we're going to dive into the office. Earlier, Randall said they do everything. They love real estate except office. I agree with him, except outside of this market. Our market's a little bit different. Most of our office space is 5,000, 10,000, max 20,000 square foot buildings. We do have a few that are larger, but we're not the type of market that has 400,000 square foot office buildings, 1 million square foot office, where gig workers are affecting it. Commuters, Zoom commuters are really affecting the downsizing of office space, which is why it performs so well in the high desert. 2.8% vacancy rate. It fell from 3.4. It's been dropping steadily for 15 years. We have a very healthy office market. Lease rates dropped from $1.83 a square foot to $1.53 a square foot. That's a significant drop, but we also had 62,000 square feet of negative absorption in 2022. Last year we had almost 79,000 square feet of positive absorption. Simple math, supply and demand. You have a lot of product, you drop the rates, things get leased. So here's a breakdown. I won't go through it because I know we're a little tight on time, but obviously Victorville has the most amount of office space at 2.6 million, followed by Apple Valley. Still, we don't have much new product coming onto the market. If you haven't figured out, we love graphs. This is how I communicate with my wife on when we need a vacation. I show work days, vacation days, work with the axis. So as you can see, a steady decline in office vacancy rate over the last 5 years. We did have a blip. I think basically rates got a little bit too expensive and then readjusted during 2023. This is absorption and also new deliveries. You can see 2023 to the right, blue line going up, orange line going up. Fairly well balanced. We did start off the first 2 months of 2024 with approximately 40,000 negative absorption. I think that will be balanced out as we get further into the year. Sales volume and price per square foot, steady market, steady as she goes. You can see through the last 10 years, there's not been any real peaks and valleys, but we have seen the price per square foot drop from $162 a square foot to $145 a square foot. Only a few sales can impact that number because we don't have a large, like for instance, last year we did $26.7 million in sales. So, a $2 million sale at a low per square foot can really drive that number down. A couple notable transactions: a 20,000 square foot multi-tenant building on Mariposa in Hesperia sold for $5.8 million, representing almost $290 per square foot. It sold at an 8 cap rate. That's something to take note. We are finally starting to see cap rates move up. The next two comps are medical buildings, one in Victorville, 9,300 square feet, sold for $2.3 million, $250 a square foot. It doesn't have a cap rate associated because it was an owner use. And also a medical building in Apple Valley. Again, owner use, no cap rate, but it did sell 7,000 square foot building for $1.84 million, $261 a square foot. So vacancy rates, like I said, did drop. 79,000 square feet approximately of new, absorption. New construction, interestingly, we have almost 47,000 square feet under construction, all either government use or medical, owner, or build to suit. Nothing on spec. Sales volume, as I mentioned, did drop 34.8% year over year. We had a little under $27 million in transactions, and the lease ask rate did decline quite significantly, 30 cents a square foot, from 2022 to 2023. So with that, I'm going to dive into retail real quick. Retail actually had a very balanced year. Actually, it was a very boring year, let's be honest. It was 1,400 square feet absorbed. 1,400 square feet, that was it. But it was positive. I always like green. The lease rates increased 2.2% from $1.36 to $1.39, and the vacancy rate stayed level. It was 5.2% in 2022 and remained at 5.2% in 2023. Again, this is a distribution of square footage among the cities. We continue to grow in retail, and including this year, which I'll show you, almost 250,000 square feet of new retail coming online. Again, pretty graph. I love, in our business, we love when the bars are going down. That means vacancy rates dropping. And then conversely, the line goes up because that means the dollar rates. We've had a consistent increase in rates for over 10 years in the retail sector. Again, this is a deliveries and absorption graph mixed with the vacancy rate. There is one blue line that drops below the line, and you're thinking, wait a minute, how did we lose 100,000 square feet? Did it disappear? Did we remove it? Actually, it's a reclassification. The former Walmart building on Bear Valley Road, which was turned into an Amazon last mile, it got reclassified from a retail to an industrial use, thus we lost 100,000 square feet. So that was the really only major change. Other than that, you can see 2023 and 2024 are kind of boring. Not much in the way of new deliveries, not much in the way of negative or positive absorption, but we do anticipate about 250,000 square feet coming online. Again, sales price and per square foot, similar, fairly benign over the last 10 years, fairly stable, but we have seen a steady increase in the price per square foot, and we see that, of course, with building costs going up, we see the price per square foot moving up. So, notable transactions, Walgreens on Roy Rogers traded for $6.88 million, a little under 15,000 square feet, and it traded for a 6 cap rate. Just a year ago, this building would have traded for probably a 5.2% cap rate. 99 cents only in Jess Ranch, $6.1 million for a little over 14,000 square feet. That traded for a 5% cap rate. It was on the market for 90 days, which is very interesting. Typically, a Class A asset like this moves pretty quickly. I think it was the cap rate that actually slowed the transaction as buyers and sellers try to meet in the middle. There's still a disparage. Okay, had to talk about another car wash. Couldn't leave it today without talking about. What's interesting about this is a Quick Quack car wash on Bear Valley Road in Hesperia, off of Fish Hatchery Road, across the street, actually. It sold for $3.2 million. That was just the land lease, not the actual car wash itself, just the land lease. Sold for a 5% cap rate, which was the lowest cap rate for investment-grade property last year. The year before, it was 3.42%, a 1.5 higher. The cost of capital has really pressed cap rates up. So, as I said, vacancy rate, not exciting, remained at 5.2, which is low. Anything below 6% is a tight market. Rents have gone up. We've had positive absorption, 9,300 square feet of new deliveries last year, 250,000 square feet under construction, and we have the lowest vacancy rate that we've had in 17 years. Moving forward, I think rental rates are not looking to skyrocket, but I do think they will stay in line with CPI or COLA. So land actually had the largest decline of all the asset classes last year. This graph is really crazy. There's no valley in the middle, right? We had the 2000s, everything was crazy, and then we went dormant during the Great Recession. One of these days we'll stop using that term. And then, of course, the last 3 years we had a nice peak. Interestingly, you notice to the right, the peak in 2022 is related to that, again, $87 million single 65-acre land transaction, which really spiked. Otherwise, 2021 would have been the spike year in the last 3 years. So we've had a slight decline in land sales and also land transactions. Our average transaction last year in land was $213,000. The minimum sell was $100. I got to go back and look that up. I'm curious what someone bought for $100. Interestingly, there's a land assemblage in Adelanto for $19.86 million. The total volume was a little under $305 million. The average days on market increased slightly, 3% to 228 days. And the total transactions, as I mentioned earlier, dropped from 1,919 transactions down to 1,429 transactions. Now think about that. We had 2,100, a little over 2,100 total transactions last year, commercial, multifamily, and land. Land was almost 1,500 of those 2,000 transactions. We are a land-driven market. So, sales volume was down 42%. Again, adjusted for the $87 million sell, it's closer to about 28%. Transaction volume dropped 25%. We did notice a decline in sales in the scattered single-family lots, as Mayor Nassif had mentioned earlier. Apple Valley tends to be an infill onesie building, build one here, build one there, why we call them scattered singles. We did see a 28% decrease in sales volume, and I think that's, one, people looking to see where the economy is going. Two, the price of the scattered single lots has increased significantly. I have to revise this 33 million square feet after seeing the mayor's talk. It might be closer to 40 million. Now, again, this is entitlement. This is still working through the process. It's not built yet. But to put it into perspective, for every million square feet delivered, there's a 500 jobs created directly and another 500 jobs created indirectly. So hypothetically, if we have 30 million square feet come online, that's 30,000 additional jobs in the desert. So industrial and residential sectors have been the primary focus and will remain the primary focus for not only development, but for also land acquisition. Capital markets, again, I talked about earlier, this looks like a really bad EKG. I'll explain it real quick. Cap rates low, 10-year T-bill and mortgage rates high. When they get so close, there's no sense taking the risk, as I think was talked about earlier. I can go down to the Citizens Business Bank, our global credit union, and I can get a CD for 5%. Why would I buy a property which has maintenance, tenants, issues for 5%? I'll just give them my money and have them send me a check every month. That's the mindset. We have to get the cap rates moved up so risk is rewarded. So I may not use that graph. I don't even understand that graph. I look at it sometimes again. So where are the cap rates? What's a sweet spot? Between 5 and 7%, which is the two bars in the middle, which represented 50% of our transactions in the investment grade properties. It did decline significantly. I still think we have a chasm between buyers and sellers. And buyers were really looking for carnage. They were thinking the economy is going to crash, we're going to have a lot of distress, loans will reset, the sellers will be begging us to take their properties. There was no distress. Defaults are under 3%. So right now we're in a transition market. We're in a transition to where sellers are having to realize that borrowing costs have raised to 6.75 to 7.25, depending on how you structure that loan. You can't buy a property at 6 cap rate and have a mortgage at 7%. A lot of the activity that we saw in 2023 was 1031 tax exchange. So there's a tax element that's driving that investment, or there's an add value component. They bought their property for $2 million, hoping they can increase the property value to $3 million, and they're not as concerned about the cap rate. So moving forward, commercial rates have stabilized. Yes, I miss Christmas. I miss 3.5%. Those are long gone. Do I think they'll come back? Hopefully, maybe into the 6 range. But I think the days of waiting for 3.5 to 4% commercial loans, that sunset has been completed. The average cap rate among all asset classes was 6.2. That's a 100 basis point increase over prior year, which was 5.2%. And moving forward, I think we will see cap rates increase. Borrowing costs, I think, for at least the first half of this year will remain fairly stable. So 2024, as I mentioned earlier, we did $773 million in the high desert for land, commercial, multifamily. Land accounted for almost 40% of those total transactions. As you heard today, large format industrial buildings, 1 million square feet and larger, are going to continue to probably dominate our real estate news over the next few years. New housing starts increased 4%. Builders have been very cautious. You heard some numbers today bringing 900 homes online each year, or 500 homes coming online in Victorville next year. 2005, almost 6,000 homes came online. So this year we are below 2023 we're below 1,000 homes coming online. We are not building enough housing to keep up with the demand that we currently have. Speculative development is non-existent unless you have 1 million square feet. And still, it's very limited. But the days of building a retail center or an office building on spec, hoping you build it, they will come, we don't see that. If you go into a bank, go see Gwen and Cindy at Global and say, I've got this idea of building a 40,000 square foot, and they'll say, do you have any tenants? You say, well, I don't know yet. They'll show you the door. They're nicer than that. But the reality is the project has to have tenants. It has to be a viable project from day one. So defaults in our market, I think, are going to remain low. We don't have the exposure. Someone once said, if you owe the bank $1 million, you have a problem. If you owe the bank $1 billion, they have a problem. Our market is made up of roughly $1 to $2.5 million properties. A loan reset is not as dramatic as if you're sitting on a $150 million office building in Los Angeles. Additionally, a lot of our assets have longer terms than more of the REITs and the larger asset classes, which might have a 3-year rolling or a 5-year rolling. If you have a $150 million building and it resets from 3% to 7%, that's going to be an issue. Those buildings are in the metro markets, not necessarily here in the high desert. So, external influences. 3 years running, recession. We keep talking about this. I had to put it up there because why not? Let's just keep on the slide. I think the likelihood of recession, I'm going to leave that to Dr. Chris Thornburg. He's the economist. We've been talking about so long, I have fatigue. Let's just remove it out of the conversation. Global conflict remains a concern, obviously, if there's trade disruption. I won't even get into the Fed. I'm going to let Chris handle that. It's election year. Both parties are wrong. They're both right. They both hate each other. If the other guy wins, it's going to be devastation. Ignore it. Turn off the television. Throw the newspaper away. Don't let it disrupt your life. Or more importantly, don't stop spending and get worried that we're all going to die if that guy's elected. So again, negativity in the media can affect us. And a decline in consumer spending could also impact the retail sector. California's projected, last I heard, was a $70 billion deficit. You know how they typically look to fill the deficit, taxes, so that's something else that could possibly impact our market moving forward. New housing is in 2024 will increase over 2023. Multifamily did slow a bit in 23 over 2022, but we still believe there will be steady development in multifamily. As Bob mentioned earlier, 100,000 square feet and less in the industrial sector is a very tight market, 2.2% vacancy rate. We need more product. Cap rates to increase roughly 1%, and the low inventory across all asset classes is going to keep rates fairly strong and probably growing in line with CPI. As I mentioned earlier, our region, I believe, has strong fundamentals. We didn't overbuild like we did in the 2000s. We are short on housing. We have low vacancy rates across all asset classes, and we have the potential to add 50,000 jobs in our region over the next 5 to 7 years. I would consider that pretty good news. So this is my only concern. When the Fed chair is scratching his head on trying to figure out what to do with the economy, oh, wait a minute, I was watching the news. I shouldn't have. So